following is an update and technical analysis on NG, natural gas futures, one of the largest components and commodities to the energy sector based upon the daily interval where I had mentioned on the 5th of October 2023, where trading spot price 3.17, that it would be an ideal, most valuable full short trade position correlated with the 618 fibs retracement upon reacting and or continuing the uptrend, continuing the counter trend snapback rally based upon a heavily defended bottom of this primary trading range channel, reactionary low, uptrend line, and that was really the most pivotal key inflection point for long traders and or bull traders to defend heavily on a complete breakout. A breakout above this monthly price resistance correlated with the primary minor downtrend line, and we completely gapped up, end up consolidating, back tested the 382 fibs retracement near the button there, back tested additionally the 382 fibs retracement, and then officially broke out. And if we continued, if and when we went on to retest and or backtest this key inflection point, watch for a solid, long traders, bull traders wanted to see a solid daily candle close right up above, completely popping this level for any short sellers and or bear traders to start scaling out, stops to go off, covering their position at all costs to go on to retest the 786 fibs retracement correlated with the 367 price resistance. Whereas bear traders, short sellers, they want to see a complete rejection of this top of the primary trading range on a retest, rechallenging of the 50% fibs retracement. And here's the update, where the entirety of the trade correlated with the 618 fibs retracement was good for, call it a 7.82% crash to the downside, and we bull traders, long traders end up defending the 50% fibs retracement called 3.04 price support really to the butt end, especially if you're an active and or day trader. Netted you about 2% gains on a move to the upside today, and here we are testing a key inflection point within the technical momentum indicator dimensions, where we have the beginning stages and foundation of a potential bearish crossover in the moving average convergence. And it will mark the bottom, the near-term bottom, if not continuing on a complete sell-off, on a continued sell-off breakdown, applying more damage to the technical momentum indicators than there already was, where you have the stochastics 1033 on an already confirmed bearish crossover below its 85 threshold, and that is already damage being poured into the technical momentum indicators. And I believe the 50% fibs retracement, call it the 3.04 price support, will be the biggest key inflection point in quite some time for weeks on end for bull traders and or long traders to defend heavily at all costs. If we take this level out, short sellers take that level out, we have a solid daily counter close below that key inflection point, you will have a confirmed moving average convergence crossover there, and then the technical momentum indicator on a potential rechallenging of its zero line threshold, where you have the oscillator histogram starting to have a little bit of a red candle close down below there. Whereas bull traders, long traders, they want to make sure that this moving average convergence is a slip and slide, averting the bearish crossover there, complete slide out, and complete rechallenging of the 618 fibs retracement. And the potential of the top of this primary trading range would be the most key inflection point for bull traders, long traders. Pop that level, continue the uptrend to the upside, and take out this primary channel that has been building energy for quite some time in a vast consolidation phase that has been a multi-year key inflection point for months on end now. And again, watching the charts manufacture the headlines on this momentum we never had. The bulls were never in full control. You wanted to see a solid green candle close of this magnitude, and we never got that. We end up having just nothing but pure volatility for the last full week on end, where you had a first initial solid candle close up above. The very next day was met with volatility. Looked like we were going to start to peel on out, go to retest the 786 retracement, only to close back down on a hard smackdown close down below that key previous high there in that intraday high, having an additional, almost a doji star looking setup, very indecisive candle, followed by the next day of almost a near breakdown in that key inflection point off the top of that primary trading range, only to close up higher. And we end up backtesting the bottom of the top of that primary channel once again. Had a nice clean reaction, and then were rejected impulsively right back into it, having a momentum fueled overshoot right back into the top of that 618 fibs retracement, only to have a complete sell off and a gap down, complete gap down to the downside. These are your key pivotal inflection points to hone in on, to respect at all costs, and a great play for short sellers to cover there. They additionally want to see that breakdown sell signal, the additional breakdown below that key price support on a prolonged move to rechallenging of the 50-day moving average and the 382 fibs retracement, call it 278 price support, and that is a big price support level there, with just a multitude of reactionary highs and reactionary lows really across that entire sphere there. So that will be the ultimate key inflection point to watch, and then additionally the bottom of the trading range and channel to hone in on with the 200-day moving average. aside from the technical damage that has been inflicted upon these technical momentum indicators, you do have a solid bullish golden cross setup where the 50-day moving average has punctured the 200-day moving average. But talk about charts once again manufacturing the headlines where natural gas futures tumbled as much as almost 4% here on Monday, hitting a new low for the week, where this drop was primarily driven by record high natural gas production, decreasing gas prices in Europe, and predictions of mild weather in the United States through late October. These factors are expected to result in reduced demand for both heating and cooling.